What's going on, everyone? In this video, we're going to be comparing two different real estate crowdfunding platforms. Number one is going to be DiversyFund, and number two is going to be Fundrise. Now, I think it's important before we jump into those comparisons, let's actually talk about real estate and crowdfunding. So a lot of you watching this video have probably at some point thought about wanting to invest in real estate, right? I mean, it's great diversification for your portfolio, especially if you're only investing in stocks and bonds. It provides a really nice balance to your overall portfolio strategy. Now, the biggest barrier typically is real estate is extremely intensive in terms of to invest in, right? If you're going to go out and try to buy a property, it requires a lot, right? It requires a lot of capital, right, for the down payment. And then it's also, it requires very heavy operations, right? You're going to have to figure out the lending side. You're going to have to figure out the acquisition side. You're going to have to figure out the lease and tenant management side. Construction and contractor management side, right? It's a full-on business. And for a lot of people, they don't want to take that on, right? They want the exposure of real estate, but they don't necessarily want to start a brand new business in investing in real estate. And I can tell you for this from experience because one of my businesses investing in real estate, and it is a full-time job, right? It requires a lot of effort. So enter crowdfunding into the scene, right? So crowdfunding, not some novel concept, right? I mean, it's been around for a while. Basically, you pool a bunch of investors' money together, and it could be in small sums, and you use that to invest in companies, initiatives, projects, nonprofits, right? It's pretty widely used. So in the real estate space, though, it is a little bit newer. And it basically allows investors to pool their money together, right? Again, each investor can put in just a small sum, but when they pool a lot of investors, small sums obviously become significant, and then that money can be used to invest in residential and commercial real estate. Traditionally, this kind of investing has been more limited, right? You could either do it through investing in REITs, which are essentially corporations that you buy shares in, that they go buy real estate, but their portfolios can have also a mix of non-real estate assets. And we're not going to talk too much about REITs, but traditionally that was your other avenue. Or if you were an accredited investor, you could invest in, maybe it's local operators projects directly. Again, with crowdfunding coming, with a lot of these platforms coming out the last 5, 8, 10 years, that's kind of changed the game and allowed your average everyday investor to take small amounts of money and invest it into commercial real estate. So now with that background, let's actually get into the comparison of DiversyFund versus Fundrise. And we're going to start by number one, overall strategy and investment philosophy. So let's start with DiversyFund. So the way DiversyFund works is if you invest some money, you're basically getting a share of their investment trust, which directly buys and manages value-add multifamily. Now, so one key difference I will point out, a lot of crowdfunding platforms kind of act as brokers, right? Where they essentially pool the money from investors, and then they connect them with local developers, operators, syndicators, whatever, right? And then they essentially they broker that that exchange. DiversyFund is different because they are the operators, right? So you're essentially going right to the operator, right to the guy or the company that's investing in the real estate. And DiversyFund has a very, very narrow and niche focus, right? They only focus on value-add multifamily. If you actually look at their portfolio online, you'll see that they own everything from student housing complexes to much larger multifamily complexes like 150 and 200 units and up. And those are obviously quite significant. So their strategy, again, pretty straightforward. If you look at value-add multifamily, they will buy a property that is cash flowing. Then their goal will be to make some sort of improvements, whether through construction, better management, whatever it may be, and essentially increase the cash flows and also increase the value of the property, hence creating appreciation in value. So they've actually got 3 criteria that they look for in their acquisitions. Number one, they look at the local economics, and they have to believe that there's potential growth in the local economy, right? Because real estate is obviously very impacted by the local supply and demand economics of the market, right? It's not, one of the biggest things I've learned is you're not actually investing only into the real estate, but you're actually investing into the local economy. So it's key to understand how is the local economy doing? Is there been population growth? Has there been job growth? Have there been any major industry shifts that have maybe moved corporations into that local economy, right? Because all of those things are going to factor the amount of people living there, the demand for housing, the demand for apartments, and obviously that will impact rental prices and values, etc. Right? So that's the first factor they look at. And the second factor they look at is, again, their value add, right? They're not opportunistic. They don't buy super distressed. So for them, on acquisition, the property has to be already cash flowing, right? So they're not going into these much higher risk projects where, for example, maybe the complex is maybe only 40 or 50% leased out or is in complete disrepair, right? No, they look for something that's already cash flowing. But factor number three, it's got to have some sort of value add component, right? So there's got to be something they can do. Maybe it's renovate the units. Maybe they're going to build out better amenities to attract better tenants. Maybe they're just going to manage the property better and cut down expenses, right? But there's got to be some sort of value add for DiversyFund so that, again, they can make those improvements and increase the rents. Now, if you're not familiar in commercial real estate, the reason why you obviously want to increase the rents is not only to get better cash flows during the duration of the hold period, but in commercial real estate, values are actually a function of your gross rents minus your gross expenses, or called the net operating income, right? So basically, by increasing the cash flows through these renovations, DiversyFund can actually increase the value of the asset and, again, create value appreciation, which can be passed down to the investors. Now, we'll talk about this more in the next part, but because of this strategy, right, because it's a very capital intensive strategy and it will take time, right? I mean, stabilizing multifamily buildings, especially 200 unit complexes, can take years, right? I personally buy 3 to 6 unit complexes where I live, and I can tell you, I do the same strategy, and I can tell you even with 3 to 6 units, it can take 1 to 2 years to stabilize buildings. So the point is, it's a long-term play. So if you're going to be investing in DiversyFund, you've got to have more of a long-term outlook, because you won't be getting cash distributions and you won't really see the effect of that investment for a number of years until the building is fully stabilized and sold. So now let's talk about number 2, Fundrise, right? And compare to DiversyFund. So Fundrise is a different model than DiversyFund. In Fundrise, you're also buying a share into into what they call an E-REIT, right? But investors will actually own shares into diversified portfolios of properties with Fundrise, right? And that could be a mix of equity and debt investments. So unlike DiversyFund, which only focuses on value-add multifamily, in Fundrise, you can be exposed to multifamily commercial projects, new construction, and you just have a much wider spectrum of the exposure of the type of real estate that your portfolio is exposed to. Now, because of this type of structure, Fundrise actually offers 3 different types of funds that you can invest in that will depend on your goals, on your investment goals. And the 3 types of funds are your supplemental, your balanced, and your long-term growth. So your supplemental fund is basically a fund that's going to be more focused on creating stronger cash flows during the hold period, right? So this kind of strategy is great for people that are looking for, consistent income coming in from their investments. So maybe you're a retiree looking to just build out an income stream. Maybe you've got a goal of some sort of income goal you got to hit. So that would be a great option for you. The balanced fund is more balanced than that, right? So they still have their quarterly cash distributions where you will get some cash flows on your hold, but that fund also has a little bit more of a prioritization about appreciation, right? And long-term growth of the portfolio. And then finally, the third one is the long-term growth, right? And as you can probably guess, that fund still will have cash distributions, although obviously much smaller distributions than the other 2 funds, but it's going to have a much greater focus on long-term appreciation and long-term growth. So this kind of portfolio is great for people that are maybe more concerned about their net worth in the long run, right? That don't necessarily need as much cash flow today. So maybe you already got a great job or a great income stream. You're just more focused about building out your net worth over the next couple of years. So that would be the better fund for you. So let's talk about factor number 2, which is liquidity. And liquidity is always very important to talk about, especially when in the context of real estate, because real estate, unlike your stocks and bonds, is way less liquid, right? Once you invest in a property, it is much harder to pull out cash than it is to sell out a couple of equities or bonds. So with DiversyFund, it is actually it's a pretty illiquid investment opportunity, and you need to be aware of that and comfortable with that. Now, why is that? Well, remember what the strategy is, right? Their strategy is to take buildings that are performing decently well, and over the course of a number of years, improve them, right? And create better rents and create better value. Now that's a very heavy, now the way you do that is essentially by reinvesting in the building, right? So all the cash flow that comes off the building during the hold period actually gets reinvested back into the property, right? So, whether they'll take their cash and they'll reinvest it right back into more construction, more renovations, more improvements, all in that goal of maximizing that value at the end, right? So they don't offer any cash distributions during the investment period. So again, what that means to you as an investor is if you're going to invest that money, you have to be ready for that money not to be seen for a number of years, right? So once you write that check, you got to be comfortable that you're not going to get any returns on it for a couple of years. You're only going to get kind of that bigger bang return once DiversyFund completely stabilizes the building and decides to sell it off or maybe refinance or something like that. Now, Fundrise is a little different. Fundrise actually does offer quarterly distributions, as I've talked about when we talked about those 3 different fund structures, right? So you, as an investor, you can actually accept those quarterly distributions. You could also, if you don't want that cash, you can also reinvest it right back in and continue growing your portfolio. Now, the other thing I should mention about Fundrise is they do actually offer options to potentially, a keyword, liquidate your initial investment. Now, they have the right to deny that request, but they do put it out as a potential option. Whereas again, DiversyFund, once you throw that cash in, it is staying in there until the business plan is executed and the asset is sold off. So, that with these 2 points, again, it's really important for you as an investor to understand your finances, your cash positions, your plans over the next 1 or 2 years, because if you're going to need cash for whatever reason, maybe you're going to buy a house, maybe you're going to buy something else or invest in a business, right? You want to make sure that you're investing into the right structure, because you don't want to end up maybe investing in something and then realizing you're going to need that cash pretty soon. Let's talk about factor number 3, which is fees. So as I mentioned before with DiversyFund, remember, they are actually the operators of the project, right? They're not connecting your money with another local operator. They are the operators. So what that means for you is they basically have an in-house team of everything, right? They have an in-house team that does the research, the evaluation, and then the management, executing the business plan, and so on. So what that means, the benefit that means to you as an investor is they don't actually have any fees, which is great. Now, Fundrise is a little different, right? So on Fundrise, you do actually have 1% fees, and that's going to be a mixture of advisory services as well as management fees. The other thing with Fundrise, they do say is they do have the option of tacking on another 0 to 2% of fees, which could be fees for acquisition, any sort of financing placement, debt and equity placement, right? Or any other originations. And finally, let's talk about actually historical and expected returns. So Fundrise says that their returns are somewhere in the ballpark of 9 to 12% annualized, whereas DiversyFund's returns are historically placed at around 11 to 18%. Now, again, you can obviously say, well, why would I invest in DiversyFund, right? Obviously, their returns are higher. Remember, that's part of their business strategy, right? Their business strategy is they don't do any cash distributions for a couple of years, and they very aggressively reinvest into the property in order to hit that big final sellout. So that's good for some investors, but again, if you're an investor that maybe wants those quarterly distributions and maybe wants maybe a bigger exposure to different types of real estate, right? Then Fundrise could maybe be a better option, even though the returns are low, right? Because remember, DiversyFund is only multifamily, whereas in Fundrise, your portfolio can be exposed to multifamily, commercial projects, new construction projects, right? You kind of have a broader diversification of real estate that you're getting exposed to. So this is when it all comes down to personal investment philosophy, right? It may be if for you, you believe in a certain asset class or a certain property type, then maybe, you know, you'd go one way. If you're looking for cash distributions, if income's another important factor for you, you'd obviously go another way, right? So just as an investor, make sure to figure out what do you want your exposure to be to, what kind of real estate you want to invest in, and then B, obviously, what are your finances? What do your financials look like? And then make that strategic decision once you have that figured out.